your behavior determines your wealth. Mr. Siddhartha Dash. Honor Mr. Siddhartha, Mr. Govindarajan, our own social media expert. He
Quick reading of the profile of Mr. Siddharth. Mr. Siddharth joined UTI in January 2008 and over last 15 years has played a pivotal role in establishing and developing the PSU business for UTI. He has taken over as the zonal head for South UTI in January 2022, which is an accomplishment in itself. Can we have a round of applause for him, sir? Siddhartha has a rich experience amongst the best brands in financial services such as GE Countrywide, Chola Mandalam Finance and ICICI Bank. He has been instrumental in setting up the Crosswell team for SME clients in ICICI as well as profitable franchisee in different locations in North India. While working with Chola Mandalam Finance, he has hands-on in-depth experience of the financial markets both in assets and as well as liability side. Welcome, we welcome you, sir.
For the generous introduction and many congratulations to IFPA for this annual Utsav, which I think brings in a lot of us together for a day of learning, sharing. I think it's important to, the industry is growing at a very, very rapid pace. All of us are part of this very, very rapidly growing industry. And, we all need to gather once in a while, take a step back, look at what's happening in the industry and maybe put our thoughts together to try and make sense of how things are going forward and then go out to the market and put our best foot forward. So thank you for having us here. And I have a small presentation which is essentially about behavior, because a lot of things, in fact, everything that we do in life depends upon how we are tuned to do it. What is our behavioral aspects? What is our behavioral instincts towards any aspect of life? And investing is again one part of that. One very important part of our daily routine is investing, and our behavior will determine how we are in terms of our investing, whether we are generating a wealth to its to the required extent. So I have a small presentation on your behavior determines your wealth, and this would be essentially for us to take forward this thought to our clients. Okay, now there is a very there is a difference between what is called the investor return and what we talk about an investment return. Investment return is essentially what we generally from the mutual fund industry show you, all of you, in the charts, right? We show how the Nifty CAGR has gone up by 15.5%. We show how our schemes are giving you 20-25% returns. So that's the investment return. But what is the investor return? The investor return typically is compromised with respect to the investment return. And that is the behavior gap. That the reason for this is the gap in the behavior of the investor. So that is something that, as a responsible distribution fraternity, we need to communicate to our clients, to our partners, to ensure that this behavior gap is reduced to the minimum. Sorry. Now, there was a Morningstar Mind the Gap study which happened in November 2022. And the study considered asset weighted returns across India mutual fund categories for the data as on June 2022. Now, it's very interesting to see that, so you have the blue bars, which is the investment return, and you have the orange bars, which are the investor returns. And if you look at 3 years, 5 years, 10 years, there is typically a gap of about 1.5 to about 2.80 CAGR between the investment return and the investor returns. Now, while these figures may not look too, in terms of percentage points, may not look very big, but if you look at an investment value of about 1 crore over a period of 10 years, that, translates to a potential gap of about 75 lakhs, which is huge. Because when we talk about investments, we are generally talking about long-term investments for the customers. So essentially, volatility and emotional responses. What is the result? What is the reason for this behavioral gap? The volatility and the emotional response. The volatility that is experienced in the markets and the emotional response that we as investors have results in this behavior gap. Now I'll elaborate this a little more. So you have the last 45 years data, of the S&P BSE Sensex from April 79 to March 24. So while you look at a straight linear, CAGR of 15.24, which is the investment return, but you have a lot of periods where there is setbacks and crisis. You have balance of payments crisis, political uncertainty, .com, market sell-off, GFCs, Eurozone, global sell-off, coronavirus. So all of them are part of this 45-year-old history of the Indian capital markets. Now, there has been a lot of volatility which has been in the market, but and while this Harshad Mehta scam might look like a small blip in this particular, but when you reduce the time period, this will again be a huge, almost a 30-40% kind of a correction which happened here. So you look at the CAGR, which is 15.24, but the volatilities are also part of that story of growth. One more point is that the markets are more volatile than the growth and earnings. If you look at GDP growth and if you look at earnings of companies, the market returns will be much more volatile. So you have GDP which has grown again over the last 20 years at about 12.7%. Corporate earnings have grown by about 11.5%. Nifty has grown up by 17%, but look at the volatility that Nifty has given. It's about 31.7%, right? Whereas a volatility in the GDP is just about 4.7%. This slide is just to illustrate the fact that higher returns will be generated, will be accompanied, be sure of it, by high volatility. So investors, the bottom line is investors may find participation in the wealth creation journey of equity difficult because, of the volatility which is present in this. Fortunately, or let's say unfortunately, I think the feedback that I've got from certain partners when I visited the market is that some of us are very worried to a certain extent as to why there is no, corrections which are happening, because over the last 4-5 years, investors are just seeing a one-way run and they're not seeing a, correction which is happening. That is also equally important in any equity markets or in investments. So it's like investment, again, I think that's a very, cliched slide. Investment is like a marathon run where you have to run for the long term. You have to prepare for a steady, consistent pace, look at endurance and look at, different types of, so marathoners will have different types of training methods, training focus as compared to a sprinter, which is typically, the traders, right? So if we are here as a marathoner, as an investor, our skill sets would be much more different. Another fact, so if you look at the last 45 years, the number of days where the days where the markets were making an all-time high is just about 7%, and the number of days where the markets were making 52 weeks low was 9%. So just 7% of the days, in the last 45 years, the markets have made an all-time high. In spite of that, the result of staying invested is about 15.5% CAGR in the Nifty. So, the less you look at it, the better it is. The less you focus on the market, the better it is. Again, now, we say that, okay, if you are at 60% success rate in terms of getting your decisions right, are you successful? So we have a very successful captain of the, home team here in Chennai, CSK, who has, won 133 matches out of the 226. And he's probably the most successful IPL captain that we have seen, right? So 60%, just 60% of your decision, are you, if you get it right, can you be successful? A big yes. So you need not have all your decisions right, and it will never happen. All your decisions will never come out right, but just 60% of that and you are through. Okay, so if you look at one-day return for the last 45-year period, if you look at one-day returns, 53% have been days with positive returns. Okay, 53%. So it's more or less even Stevens between the negative returns and the positive returns. 53% of the days you have had positive returns, 47% of the days you have negative returns. Average positive returns in positive days is about 1.707 and negative is 1.075. So this slide essentially communicates that It's pretty even Stevens with respect to positive and negative returns. In spite of that, we have made phenomenal returns over the last 45 years. The equity markets have given phenomenal returns of about 15.25 CAGR. So it is important to ensure that you are looking at the very, very long term for generating your returns. Okay, and we all know this fundamentally. An SIP sort of enables you to manage volatility, and one very critical example here. So we have taken a 5-year SIP return for Nifty 50 TRI over a last 15 years period, and while the average is at about 12.5% in terms of the SIP returns for a 5-year period, you see this dip here, which happened during the coronavirus. So 5-year SIP return at a market trough of March 20 was at about, so here the customers were getting minus 2.80 CAGR for the last 5 years of SIP that they had done. Okay. Just 1 year later, they got a 15.12 CAGR over the last 5 years. They just stayed. So a lot of people panicked during the the COVID crisis, and immediately when the market tanked, the last 5-year SIP returns were negative. But just about 1 year later, the returns became 15.15%, 15.12, which is above the 15-year average of 12.5%. Another aspect that we need to keep in mind, look at rolling returns rather than point-to-point returns, because rolling returns have a habit of being exaggerated over a period of time. So we have the flavor of the markets, which is mid cap and small cap, and as of March 31st, 2024, small caps giving you about 64, whereas mid cap giving you 57. But these are moderated once you look at a 1 year and a 5-year horizon on a rolling return basis. So as of March 9 to March 24, if you look at a 1 year rolling, your average returns sort of tend to sort of moderate, and that is something which I think we should not get too excited, because customers generally tend to get very excited about 1 year point-to-point returns, and the sense of getting the decisions right gets clouded by this kind of data. So we need to ensure that the data that we are presenting before our clients and that the clients are reading is credible, and rolling returns is definitely one of the methods which is much, much more credible as compared to point-to-point returns. This is again one more slide about rolling returns. If you look at just the period between April 8 to March 24, and you look at the gold returns versus the Sensex returns, gold given much higher returns. But if you come to April 9 to March 24 on a rolling basis, you have the Sensex giving you the right picture. So this is the right picture that you are getting with respect to returns between gold and equity on a rolling basis. So you may have point-to-point returns coming in, but the right way to look at it is in terms of your rolling returns. Okay, so the market cycle is not about predicting the future, it's about understanding the probabilities which are involved. It's very important to stay focused about the probabilities that are possible. Not always will you be able to predict what's going to happen. You don't know what's going to happen in the near future or the midterm future. So it's all about managing the probabilities, understanding the probabilities, getting the data right, understanding what's happening with respect to the returns and with respect to the returns that can be generated. There are some myths, or they're not myths, but there are some taken for granted relationships. For example, the gilt and the Sensex sort of move in opposite directions. Now there were two instances in 2003-4 and 2008-9 where the gilt and the Sensex moved exactly in the same direction. So markets outcomes are driven by multiple parameters, not just one particular parameter. It's very, very important to understand that markets are determined by different parameters, and if you stick on to one particular parameter, okay, the gilts is going up and we need the markets are going to come down, or the gilts are down and the markets are going to go up, we tend to fall flat on our face. So it's a much more composite way of handling your investments, handling your decisions, and you should not fall prey to a single variable correlation, because that can be injurious to financial health. Why do valuations matter? I think one of the most important thing in investing or finances is always look at buying cheap. I think that is the mantra that a lot of financial gurus have set out to us, whether it is real estate, whether it is equity markets, buy cheap. And why do valuations matter? Now some data, if you look at the last, this is a period for I think it's, yeah, from February 28 to 24. If you look at the times that the market P was less than 20 and the market P was above 20, and you look at the average forward returns of the Nifty 50 TRI for the next 1 year, 2 years, 3 years, when the market P, so P is not a very, very, great measure, but then it gives you a fair idea of where the valuations lie. And if you look at the market P when it was less than 20, you look at 1 year forward, 1 year, 2 year and 3 year forward earnings, it has been significantly higher as compared to when the market P was more than 20. So valuations level low, return probability is higher, valuation levels are higher, return probability is low. Just to add one more data point to this slide, when we found out what is the inflows into the market when the market P was less than 20, it was roughly about 16,000 crores. And what is the inflow that when the market P was above 20, the inflows was about, take a guess, it was 11 lakh crores. So that is where, the customers really sort of get into a different zone in terms of investments. You look at the difference in returns that a market P less than 20 is giving and versus when the market P is high. As responsible distribution fraternity, we have a fiduciary duty to try and ensure that the customers are well aware as to when to take a decision on how much to invest. Yeah, so it's a margin of safety. I think margin of safety is very critical when I evaluate any entry price. One needs to look at the margin of safety. So all this put together, I think one of the factors that come into picture is the asset allocation process. And I think that is the fundamental. I think these are all fundamentals that I'm talking about right now. But it's very important to step back and have a look at the fundamentals, because investing is actually very basic. We try to tend to make it a little exotic and, get carried away by various processes and products. But as long as we keep it basic, I think in the long term, everybody benefits out of that. So you look at the asset allocation process, and I'm sure all of us are well aware of it, the risk and return of asset classes in debt and equity. You look at pure equity returns over the last 20 years, you've got about 21.6% in equity versus you got a 15% return in equity versus a 6.9% in fixed income, with a much higher volatility or a standard deviation of 21.6 and 3.1. However, there is a very low negative correlation between debt and equity, making it very convenient for us to have a combination of debt and equity to try and maximize our returns and reduce our standard deviation, which is the risk, and therefore get optimal risk adjusted returns. So again, if you look at the same 20-year period, you look at 100% equity allocation, which we saw in the last slide. You look at a 50-50 between equity and fixed income, and 30 equity and 70 fixed income. So from a 15% CAGR over the last 20 years in pure equity, this comes down to about 11.5% CAGR in a 50-50 portfolio. However, what is important to learn here is that there is a significant drop down in terms of the standard deviation or the risks. So this is also extremely important. Are we looking at what is the trade-off? The trade-off, is it worthwhile? Is the 3.5% CAGR lower in terms of the returns in a 50-50 portfolio worth the risk-adjusted returns? In my view, absolutely yes, because volatility and determines investor behavior. We saw that in the last couple of slides. Investors will tend to get jittery. So this is the pure return that the investment is giving. But will the investor get this kind of return? So because the volatility is high, right? So reducing volatility is also important, because that will help modulate investor behavior, trying to give them the best returns. Again, a few very basic concepts, putting all your money in a single investment, always diversify, do not invest with borrowed money, a strict no, margin call warnings. So this is an interesting quote by Jeff Bezos, who, is very clued on to this one particular question. What is not going to change in the next 10 years? We always talk about change. We love to talk about what's going to change, how are we going to approach the new market dynamics, and that's also very important. That's very important. As I said during the opening of the presentation, the markets are going up, the industry is going very rapidly, and we need to ensure that we are prepared to face this market. However, there are certain basics which do not change. Okay, and that is something that we all need to keep in mind, because those basics build the foundation for investments. So, in his business, he was always asking the question, what's not going to change in the next 10 years? So he says, customers always want low prices and quicker delivery. This is not going to change. This is the basic fundamental which is not going to change. So, in mutual funds, customers would want returns with low volatility. That's not going to change. So that's something that we need to keep in mind, what's not going to change. And in the compounded interest formula, which is amount is equal to principal into 1 plus return raised to power n being the time, I think n is the most important factor as compared to the return. So staying in the market for as long, which is n here, is the most important factor that we need to educate our clients. I'm sure we do that, but I think that is something we need to keep on reinforcing, because when markets turn choppy, customer behavior tends to get clouded by this volatility which is happening in the market. So, overcoming the behavior gap, investing is a marathon, not a sprint. Markets are more volatile than the economy and the earnings. Volatility is a feature, not a bug. We need volatility. You don't have to win every time to be successful. Just 60% times, if you are taking the right decisions, you are through, you are home. Always considered rolling returns over, point-to-point returns. Correlations can surprise and events are hard to predict. So let's not get into too much of predicting events or predicting correlations or drawing our experience on correlations. Keep it simple. Valuations means margin of safety. Asset allocation is a friend. Diversification, of course, is a key to survival. Leveraging is very dangerous. What is not going to change? What is not going to change is customers want higher returns, lower volatility. Customers want maximum returns, lower, shocks in their life. In the compound interest formula, the time is much, much important as compared to the return. Thank you very much for being a patient audience, and hope I was of some value add. Thank you.
Can we have a round of applause?
So that was a great enlightening speech, sir.
Thank you, Mr. Siddharth, for that elaborate understanding of markets. Your talks clearly stated clarity on calculated behavior of markets. Understanding work wonders on challenging and changing your investments. So thank you much.